Hi, everybody. It's PJ Patterson for our weekly update today. And I want to talk about a number of things today. I'm going to cover US and global GDP, what I think is happening with the Fed and what will happen going forward, a little bit about inflation, talk about corporate earnings and the amount of corporate debt that's out there, a little commentary on value investing, and some very interesting articles and data points that I'll share with you on screen, and I'll talk through them for those of you that might be listening to the audio file only of this recording. The first thing I want to do, though, is I actually want to get your permission for something. And this is going to sound a bit funny, I suppose, initially, but please do let me explain. Bear with me for a second. I need your permission. I need it to be okay from all of the clients that I manage money for. I need it to be okay for me to be wrong about some of the calls that I might make or some of the investments that I may make on your behalf. Now, let me just explain what I mean by that. Unfortunately, we live in a world, especially in my profession, where there is this idea that I have to get everything right, that I can't lose money, that I can't have a situation where I made a mistake on an investment. And that is an impossible mandate. It is absolutely, if any of you listening to this have ever managed your own investments or done stock market investing or anything like that, you would know that it is impossible to be right 100% of the time. Impossible. And so the way that I approach investing, and I'll come to this a little bit later, but I've said it many times, I've written about it, but it is to be a value investor. I want to look for opportunities where I think people have overlooked something, or in the case of an overvalued investment where, I try to get out of that investment before it blows up. But back to this idea of me needing permission from you to be wrong, is that I'm probably going to be wrong a lot. I will make mistakes with regards to putting money into certain investments. And over the years, for those of you that have been with me for a while, know that there have been times where I've had a theme or a thesis, I've invested money accordingly, and it's gone against me, or it's gone against the idea that I had. But I had conviction in many respects. The gold story is a great story around me having conviction, because we're now really starting to see gold get its legs, and it's performed very well for some clients who I've purchased gold equities and gold for at the right time at the market lows. But it hasn't always worked. And every day I try to refine what I do and get as much information as I can to make a decision on your behalf and for your investments about what you should own and how we should be positioned. That's my commitment to you, is that I'm always seeking information. I'm always trying to get as much clarity as I can about what is the right choice to make right now. And I won't always be right. That is, again, it's not possible for me to always be right. The most prolific investors on the planet, the Warren Buffetts and some of the great fund managers out there who have had just exceptionally stellar track records, they are wrong a lot. And what they do when they're managing money like that, it's a little harder for me to do, but when they're managing money like that, they have to be wrong and recognize it. When they're wrong, they have to recognize it quickly and get out of the position, change their mind, reevaluate the thesis for the investment or what have you. So just to wrap this little discussion up around giving me permission to be wrong, I don't want you to worry about losing money. I know that's going to sound strange, but I don't want you to worry about losing money. It is never my objective to lose anyone money. My objective is to make you a shitload of money, right? But sometimes along the way, you've got to take some losses. Some things will go against you and will go against me. And my job as your advisor is to recognize that as quickly as possible and either reevaluate the thesis for owning something that may have gone backwards, or to quickly say, okay, well, that was wrong. That was a mistake. Let's get out and preserve the capital that we have remaining. So I just wanted to share that with you because it's been on my mind, and I think there's a real pressure cooker out there around managing people's money and the emotions and all the things that go with it. So I just wanted to have that conversation with you to say, please do allow me to be wrong. Now, let's get into our meat and potatoes of this update. GDP, US GDP has had 9 consecutive quarters of growth, which is unprecedented in the history of tracking GDP numbers all the way back to the turn of the last century. It is an incredible feat to have had that occur in the United States. And what is happening is that it's rolling over. It has rolled over. And this chart that you're hopefully seeing on your screen right now is the 9 quarters of GDP growing, and effectively the rolling over of GDP. And we're seeing that occurring into the middle and later part of this year, in quarters 2, 3, and 4 of this year in particular. This is actually, Hedgeye is a group that I subscribe to and get a lot of research data and other stuff from to help me formulate a lot of my opinions. Their data is showing that US GDP is slowing. Furthermore, we have global GDP, sorry for the quick flip through this, global GDP is losing momentum. This is not good. If you watch or read anything in the mainstream media, everybody's saying, oh, everything's hunky-dory, everything's okay, nothing to see here. But the reality is that we are losing momentum. All of the quantitative easing that was done, that has impacted markets, that's finished. The quantitative tightening that is now underway is starting to have an impact, which leads me into the next topic, which is that the US Fed, is probably likely to be quite dovish this year, meaning they will likely keep rates at their current levels, so they won't be increasing interest rates. They might lower interest rates, or they might even just stop quantitative tightening. They might just say, well, we're not going to shrink the balance sheet anymore. All of those things are quite dovish. And if rates do begin to drop for some reason, we're going to see inflation coming back into the conversation with investors. And this is, at the moment, all of this stuff I'm talking about is very bullish for metals in particular, so gold. Interestingly, it's kind of bullish for housing as well. Now, this is more US-centric in terms of housing. I'm going to just make some commentary in a moment about Australian housing. But US housing, it could be bullish for US housing. But the main theme of what I just wanted to cover there was that the global economy is not healthy, and it is declining. That's going to flow into things like corporate earnings. And this is the next thing I just want to pop up on the screen for you. It may surprise you to learn that, because I actually didn't really know this, but we are in one of the largest corporate credit bubbles in the history of the United States and probably the world, because as we all know, the things that happen in the US typically are the biggest and the worst, or the biggest and the best. So if the corporations in the United States are at the highest level of debt they've ever had, and that figure is $8 trillion, the largest corporate credit bubble ever, and we have corporate earnings falling, those have rolled over as well. So we're starting to see earnings reports coming in negative, and forward guidance is negative, and basically corporations are not earning as much as they were. And this is obviously going to be a flow-on effect of the GDP shrinking and all of those things. They're all linked. Something bad is going to happen, or could very well happen, in the corporate credit space. The other thing to mention about corporate credit is that the spreads on corporate credit are at their lowest levels in history. I wrote about this a while back, I think even last year, where corporate credit, or junk bond credit in particular, was not priced correctly. So the all bonds, all credit is pretty much priced off the U.S. Federal Reserve interest rate, and more specifically, usually off the 5 and 10 year U.S. Treasuries. And I believe the 10-year Treasury right now is priced somewhere around 2.5, 2.6%. I didn't look at it today, but it's somewhere in that level. And you can buy, corporations with junk status. So this would be your double B, triple B, C, D sort of credits, can be issued at as little as 500 basis points above that. So we're talking 7 and 8%. Now this is unprecedented. Typically, when you were in the junk bond space, and they call it high yield, this is 5 and 10 years ago, you were talking about 10, 11, 12, 13% sort of yields. And the spreads were 7, 8, 900 basis points, quite a large spread. To have those spreads be so short or so small is very concerning. So really all you need to take away from the corporate credit thing is two things. Number one, it's at the largest it's ever been in U.S. history. Big problem, number one. And number two, corporate earnings are falling. Now, if corporate earnings are falling and we have the largest amount of debt ever in the U.S., and I dare say probably other parts of the world, developed world, how is it our corporations going to pay for their debt? How are they going to service their debt? Right? This is going to be a problem. So it's something that just bears watching, in my view. Now I'm just going to flip over to a chart from another service that I get on a daily basis, which is called Sentiment Trader. And a lot of these services that I subscribe to and get information from are data driven. They just give you data. And they're showing you comparisons, they're showing you data, they're showing you rate of change, data, and they're mathematically based. So mathematics, my wife is a math teacher, and she's very fond of the numbers because numbers typically don't lie. They tell a story and they don't lie. They're very pure in that sense. And this chart that I'm showing you right now on the screen is a chart of the blue line is I believe it's the S&P. Yes, it is the S&P 500. And it's a chart of basically how it's traded over the past 100 or so trading days. And it's overlaid onto an average of the last 10 or so periods of time where we had similar movements in the markets, activity in the markets, so daily trading ranges, that sort of thing. Don't get too caught up in any of that. All you need to sort of look at in this chart is how closely we're tracking the average of the periods that were very similar and where we're at. So you see that big blob there that says you are here. And to the right of that, we see this rolling over and fall in the markets. This is what is concerning me right now, is that we've gone through our little crash that we had, the V bottom we had, which is this blue line area here that I'm hovering over at the moment. This happened in sort of December it did happen in December of 2018. And we had a sharp recovery because the Fed came out and said, yep, we're dovish now. We're going to put all interest rates on hold. And here we are. We've bounced, we've gone V-shaped, and we've gone back up. Now, interestingly, when that sort of activity occurred in the past, we saw the bounce and then it rolled over. Now, will this rollover happen? Don't know. I have no idea. But there are a number of periods of time that it's correlated to. And the key takeaway here is it's something to watch and it's something to manage. And I'll explain how I'm managing that in just a moment. I'm going to flip over now to a chart of the all ordinaries and gold. So I just want to show you, and some of you may be surprised to learn this as well, but over just about every time frame, gold has outperformed the Australian equity market, the ASX, the All Ords. And a lot of people don't realize that gold has had such a great relative performance to the equity markets over pretty much every time frame, but certainly in the last 10 years. But I wanted to illustrate that by showing you this chart. So this is a one-year chart of the XAO, which is the All Ords, and gold, or its proxy rather in Australia, which is GOLD. It's the gold ETF, and it just holds gold bullion. The blue line, as you can see, has bounced around a bit. We did have some relative outperformance of the equity market over that period of time. They've diverged, they've come back together. But year to date, over the last year, we have seen gold has outperformed the equity markets by about 6.5%. Not bad, not bad. And probably with lower volatility as well. I don't have any volatility numbers on this, unfortunately. Now, just showing you a longer term chart, a 3-year chart, the equity market outperformed gold by a large margin. So 25% to 8%, what is that? About a 17 or so percent, give or take a few basis points, outperformance by the equity market. And if you think about what's happened over the last 3 years, there's a good reason for that: quantitative easing. And there's a good reason why, I'll just flip back to the 1-year chart, why it's flipped the other way: quantitative tightening. Let's go out to a 10-year time frame, because I think this is a very telling story. Big outperformance between the equity market and the gold market. So about a 40-odd% outperformance. And for those of you that have been investing with me since about that 13-14 period, where I became quite bullish on the metals and the mining stocks, we've had relative outperformance of the equity market. But I want to go to a longer term time frame and actually max this out. And unfortunately, this doesn't track the gold ETF prior to 2000 or so, 2002 or so, when it first started. But what you can see there is that the gold ETF has massively outperformed, about 100% outperformance over the equity market. And that's extremely telling. That's over sort of it's not quite a 20-year time frame, but let's call it a 16 or so year time frame. You would have been better off in gold than the equity market, or at least GOLD. Very interesting when you think about it. I do believe that we are set up now for another huge run in the gold market. Gold has begun to really firm up, and off the back of things like volatility in financial markets, the likely resumption of quantitative easing, and a few other macroeconomic factors, I think gold's time to shine has returned. And if I do this again, if I remember to do this again, and I'm sure I will, a comparative analysis over a 3-year time frame, say at the end of this year, I think we're going to see this blue line well above this black line. Now, I just want to share with you as well a couple of stories around real estate. There was an interesting article in the Sydney Morning Herald back in mid-Feb or so, about a week ago. $7 trillion question: how low will house prices go? And I always laugh at these articles because I think they're a bit sensationalist. I don't think we're going to have a crash of any description in Australian housing. I've probably said that before. But what we are going to have is continued decline, and we're going to struggle to see growth because of lending, the lending environment. So credit is still very tight in Australia. We are not seeing banks lending. In fact, they continue to frustrate the hell out of me with the questions and the stuff that they are doing to files that I'm submitting for approval. Very, very frustrating environment. I can only imagine for those of you who are trying to get money at the moment from your bank, that it's very frustrating. And let's face it, if you don't have credit growth, you do not have asset growth. It is impossible. You cannot have growth in real estate prices without banks lending money. And if they're contracting or constricting credit, then guess what? We're going to continue to have low or no growth or declining growth, negative growth in housing prices. I guess that's a good thing if you're a first home buyer and you're thinking about getting in the market. Might be great if you cashed out a year or two ago and you're looking to jump back in the market, upsize or whatever. You'll probably get some great bargains. And to tell you the truth, if you are happy where you're living now and you're not planning on moving, then all of this is just noise. It doesn't matter. 10 years from now, this will probably all be resolved. If we don't have an end of the world sort of calamitous event that puts us all back in the dark ages, then you know what? We'll probably go through another dip of some sort, and then the Fed, the ECB, the Japanese central bank, the Chinese central bank, all these guys, they'll flood the market with cash again, with liquidity, and we'll probably see a lot of that money land somehow in the Australian housing market. And of course, the pendulum of tight credit will swing back to loose credit, as it did back in the 2000s, as we went through the GFC, where credit got really tight, and then post GFC, where credit loosened up again. So, as I say, if you're in your property and you're happy with where you're living and you're not concerned about the price of your property, then just don't pay any attention to this crap. It just doesn't matter. I always say to people, there's only two times you're ever worried about the price of your house: the day you buy and the day you sell. That's it. Of greater concern, though, in the housing market is an article that I picked up in January. I meant to put this in my last update, but I just forgot. And that is, and I've mentioned this before, it's this off-the-plan risk. So a lot of Australian property investors have gotten sucked into this off-the-plan way of investing. And I'll tell you my view on off-the-plan, buying off-the-plan, is simply this. When we see credit beginning to loosen, when we see rates go up and then start to come back down, and this is a long-term trend thing, not a short-term trend thing, that's when you would buy off the plan. When you can see that GDP is rising, interest rates are falling, credit is available or loosening, and you know that circumstance should continue for 2, 3, 4 years out. That's when you buy something off the plan. Right now, unfortunately, people who bought off the plan a year or two ago, they're absolutely going to get crushed. Valuations are down. People that have bought in SMSFs, we went through this huge craze. I remember it. I was fielding lots of inquiry about this several years ago. I want to set up a super fund. I got 50 grand in my fund. I want to set up a super fund to buy property. Big mistake. And these chickens are yet to come home to roost. My office in St. Leonard's, I've got around me that I can literally see from the office window, developments that are probably representing something like 1,000, maybe 2,000 units. That is a lot of stock to come onto the market. And there's more yet to be built here in St. Leonard's and in this area. So this could be quite a serious problem. If you're unfortunate enough to have something that you bought off the plan a year or two ago, you might be in a bit of strife. Hopefully you wouldn't have done it in a super fund. If you're a client of mine, then I would have talked you out of doing that. But if you happen to be unfortunate enough to be faced with that, I hope you have enough liquidity and other assets that you might be able to buy something. To settle on the transaction, not buy something, but settle on the transaction. Now, I just want to wrap this up with some commentary about value investing that I started right at the outset of this piece, or this update. I strive to position my clients' money in asset classes that I believe are undervalued and have the greatest potential to have outperformance or move back up to fair value and then outperform over the medium to long term. That's what a value investor does. They seek out something that's underpriced, that the market has just flushed down the toilet for maybe no good reason, or that has fallen out of favor. That's really what value investing is. And in this day and age, when 90% of the trading that takes place on a daily basis is done by computers, algorithms, they don't see value. They're just trying to get an edge, and they can trade within nanoseconds. You and I have absolutely no chance against those machines. So we have to take a different approach. Find things that, again, the market doesn't love, that's out of favor, but still has value, intrinsic value. I believe that the current place to have found, or the current places to look for that value, is in the gold, silver miners, and to some degree some fixed income and private investment. And that's where I'm positioning clients right now. So if you want to have a conversation about any of those things, please do feel free to drop me a line. But just remember that your focus as an investor should almost always be on seeking out value. And of course, I'll add to that, always having adequate cash flow in your investments. Once again, ladies and gentlemen, thank you very much for joining me on this market update. I hope it's been useful. I will come back very soon with more for you, probably next week, unless something big happens in the markets in between then.